Well, what a week we had when I was doing the screens for this week's market outlook. I was thinking, how am I going to get it all in? There is so much to go over. So I thought, well, let's do it from the highest impact thing on down. And once we do that, we find that there's some things we just don't need to talk about because it just doesn't matter anymore. The Fed meeting and the press conference just doesn't matter anymore. I was going to lead off with that. But after what happened on Friday from multiple sources, none of that matters. And we're going to see how the probabilities of a rate cut have dramatically shifted for September. After Powell, there was almost no probability. And now there is nothing but probability. Let's have a look at what happened on the jobs report. The big story were the revisions. May was revised from 125, down 125 from plus 144 to plus 19. You can imagine if the plus 19 was printed at that time, followed by June being only up 14. You can imagine the market reaction if you had those 2 months in a row printed like that. We'd be 50 basis points into cuts by now, and the market would not have hit more all-time highs. We would probably be well under 6,000 on the index. So the large standard error in the data is causing an unreliable signal, and it got revised down. I would expect that this month would get revised down as well. This is what happens when sample sizes drop. Your standard error increases, so it's more likely to include zero, especially at lower levels. And as you start getting more of the data in, you get revisions, and fairly large revisions. Our next jobs report is September 5th, but pay attention to this. September 9th, you get benchmark revisions to the establishment data. I'm going to come back to this because this, based on what the administration has done after this report, it didn't please them, so they fired someone who will then begin to deliver data that pleases the king. This is going to be a big deal, which means that there is a higher probability going forward that the jobs data will be a completely unreliable signal that we can no longer count on. Let's have a look at what happened here. Let's look at the establishment data. 73,000 was the headline. Government's lost 10, so private added 83. Goods producing dropped 13, services up 96, but 73 of that was for healthcare. So if you take the 83 and the 73, really you had 10K. I call this maintenance capex. It is the jobs that are created just to keep the population healthy, but it's not really a productivity enhancing investment. It's just more of a productivity maintaining investment. And it is rather immune to the business cycle because it's healthcare. Healthcare doesn't care if we're in an economic boom or a recession. It happens when it happens. This here is worth paying attention to. Goods producing, and look at the diffusion index for manufacturing, down 4.8. This is consistent with every empirical observation through history of every country that becomes more protectionist and raises tariffs. It does not create jobs. It destroys jobs. It does not create economic growth. It slows down the economy because the tariff in the end is a tax on the citizens of the country. And we know what taxes do. They reduce disposable income. So we know that GDP is in large part a function of disposable income. The higher the income tax rate, the lower disposable income, the lower GDP growth is going to be, or GDP in general. If you want to boost GDP, you lower taxes such that you raise disposable income. And that is what the big bill did, was extend these tax cuts. But you know, as your hand is moving over here. Every good magician has redirection. You look over here, whereas over here the real magic is happening. The tariff is a tax which lowers disposable income. So this is consistent. Less disposable income, less purchasing power, where the tariff's concentrated in goods. This is consistent with all observations, all empirical observations, that it does slow down growth and it does destroy jobs. So the data is sort of suggesting that nothing has changed, no matter what the administration tells you. The administration tells you that the other country is paying the tax, that billions are pouring into the country. Billions are not pouring into the country. Billions are just shifting from consumers' pockets to government pockets. Nothing is pouring into the country. Oh, the exporting company may absorb some of it, but the rest is absorbed either through company margins or through households. And since households are the ultimate owners of all factors of production through share ownership, it is the household, either directly through income or indirectly through investment returns, that are paying the price of this. So we are in an uncomfortable situation with trying to understand what's going on. Either, because it's one of two stories, either the current administration is significantly uninformed and they do really believe what they say. In other words, they're not lying to you, they're just really, really uninformed. Or they do know and they're lying to you because, well, they can't tell you that we're making you pay higher taxes. But in the end, there are bills that have to be paid. There's debt that has to come down. I think everyone's aware of that. You have to get government revenues up. What a great way to get government revenues up, because at least they can count on maybe up to a third can be paid by other countries. So it sounds like a good deal, but it does have an effect in that it lowers employment, which lowers income tax, and it lowers growth, which lowers the tax base. So you think you're getting money in one place, but you're losing it in another. This is really a losing proposition. And the data is beginning to show it. But the king doesn't like the data, so the king has fired the person who has, and I would say, zero control over the number that gets printed. The checks and balances in there and the division of labor, it is near impossible to manipulate that data unless you get the output and you say, let's just take our eraser and change the numbers in the end. But someone somewhere along the way would cry foul. Somebody somewhere would know. However, I do have a sneaking suspicion going forward that that will be the result, that why even collect the data? Let's just print the numbers we want. Kind of is like... if you remember communist Russia and even communist China right now, no one brings the truth to the leader, because if the leader doesn't like the truth, you get killed or go to jail. And the king in the US right now doesn't like the truth. So what do you think the next person who gets hired in that job is going to do if the September numbers are really ugly? Are they going to bring those numbers to the king? Right? Household labor force down 38,000 following another month of being down. And this is consistent with the immigration policy in the U.S. Shut that border down. No one coming across the border and kick people out. You are going to reduce the labor force size. So unemployment has been holding steady. So it kind of is a signal that isn't there for us anymore, because we cannot see unemployment rising only because the labor force is shrinking to compensate the jobs report, which is below the replacement rate. We should see unemployment rising. If you held the labor force constant, unemployment would be rising. The SOMA rule would be well triggered by now, and we would have cuts. That the Fed can't see this data is shocking. That the Fed, that they must have had the jobs number for their meeting. Powell said as much in a previous conference that when there's significant reports in the week where they're making the decision, they will get an early look at it. So if they got an early look at the jobs report and still didn't cut, well, then this is no longer a decision that is grounded in the data. This is a purely political decision of, to give them some forgiveness here. They had no choice but to be pushed into. So we're in an ugly situation. Participation rate down 0.1. The employed, negative 260. So the establishment is saying 83,000 jobs created, 73,000. The household is saying negative 260. Unemployment rate up by 0.1. I saw an analysis somewhere that if you controlled for the decrease in the labor force, the unemployment rate would be up around 4.8 or 4.9%. That's 2 to 3 cuts right there that we do not have because of the unreliability of the data, and not because of manipulation right now, just because of sample sizes. And so many things going on, such as the immigration policy, which is reducing the size of the labor force to keep the unemployment rate appearing like, hey, everything looks good. High school gained 38,000, less than high school, up 38. High school, negative 566, suffering the brunt here, right? Less than BA, up 60. BA plus, up 250. Looking at age cohort, 16 to 19, down 70,000. 20 to 24, up 23. The 25 to 54 down 418, 55 plus experience winning out. Part-time, these are stated in full-time equivalents, negative 440, full-time 247, bit of a bright spot in there. Average weekly hours up 0.1, average hourly earnings 0.33 or 4%, which is not bad considering the labor force is shrinking, anywhere between 3.5 to 4.5. The Fed says is consistent with 2% PCE. We're sitting right in the middle of that at 4.03. And again, considering that the labor force has shrunk quite a bit. Average weekly earnings, because hours are up and earnings are up 0.623 or 7.75 on an annualized basis. Reason for unemployment, new entrants. Increased by 275. This was another section of the report that had reasons that looked at unemployed and the reasons they were unemployed. 275,000 are new entrants to the workforce. These are mostly your graduates who are facing a very tough job market. Duration of unemployment. This is July of last year. This is May, June, July of this year. 27 weeks and over. 1.8 million, up 179,000. The month before was up 190,000. So if you are not marketable, there are no jobs for you. Less than 5 weeks, holding fairly constant, 2.2 million, 2.3 million. Well, it's up a little bit, up 58,000, but last year was 2.3 million. 5 to 14 weeks, 2.2 to 2.1 to 2, down 97. It seems if you're marketable, you can get a job. If you're not marketable, you're not getting anything. 15 to 26 weeks, up 104,000. It was up some rough 30,000 the month before, and 27 weeks and over, up 179,000 after being up 190,000. That if there looks to be a significant building up of what would be referred to as structurally unemployed, not just cyclically unemployed. I'll have more to say about the jobs numbers when we look at some of Trump's Truth Socials on Friday. Let's look at GDP. Came in at 3%, but it is generally weak. If you look at what supported the 3%, it was the reversal of what caused the negative reading in Q1. That's really it. The drawdown of inventories that came from another quarter, and the lack of the front running of tariffs, which made it appear that GDP was adding a lot to to growth, but it looks like this, right? You have imports, and then you have this massive, well, actually, because it's a negative, let's do it the other way. It takes away from GDP because of this massive increase, and then it returns to normal. So that would show a negative amount of growth. This suddenly shows a positive amount, but really, you know, all it's doing is accounting for that big change. And then inventories during this period of time would show an increase and then a decrease. And that's really what's going on. Let's have a look at what we have. GDP breaks down into C plus I plus G plus X minus M. Look at the consumer. Of the 3%, the consumer was 0.98 of that. That is fairly weak for the consumer. Goods, 0.46, services 0.3, and break it down to durables and non-durables, 0.27, 0.18. That is rather weak. If we look at investment, negative 3.09 because of the change in inventories. We're talking about gross domestic product. It is for a period of time. So if you create or build the inventories this quarter, that is part of gross domestic product. You created that. It doesn't have to be sold. It just has to be created. But if you then sell it in the next quarter, that is not GDP. It's because, hang on a second, we counted that inventory last quarter. Selling it is just a decrease in inventory, so it doesn't count. So you have a drawdown of all those inventories matched up with the change in imports over here. Look at this though, fixed investment, almost non-existent. Residential, negative 0.19, non-residential 0.27, non-residential, that is weak. Let's jump over to government, 0.08, almost non-existent there as well. Federal, negative 0.24. Maybe Doge is doing what it's supposed to do. State and local, 0.32. It isn't much consolation to cut expenses at the federal level only to have the state and local say, well, I guess we got to pay for it now. Because you're not really saving anything. You're just shoving it down to the state and the local governments. It's still the same spending. So they cancel each other out. Savings on one side is an addition on the other. Defense 0.08, non-defense 0.32. This sort of suggests that, yeah, it's probably some of the Doge effect happening because it's happening in the non-defense. So that is weak. So the consumer is weak. Fixed investment is weak. Government, let's not look for that for a source of economic growth. And exports minus imports, 5%, but again, it's just an anomaly because of what happened in the first quarter. It's just a massive reduction in the imports. And there it is right there. As far as exports took away from growth. Lower level of exports took away from growth, 0.19. Goods, there's the big one, negative 0.35. Services still hanging out in there. And as far as imports of services 0.16 because there's nothing really much affecting that. The goods 5.02, but again you have to offset it against the drop in inventories and you have to offset it against Q1. So if we took Q1 and Q2 and calculated what GDP would be, here it is right here. This is a Q1 Q2 growth. This is the real GDP number as of the end of Q2. This is the real GDP number as of the end of Q4 of 2024. And then this is 6 months, so we'll annualize it by squaring it, take out the 1. This is GDP, real GDP growth for the first 6 months, running at a 1.2% rate from potential GDP of 2.8, or the Fed has long-run GDP of 1.8. Now, I find this troubling. If the Fed had these numbers, they could have looked at that and said 1.2% growth. That is adjusting for the front running of the tariffs. That is adjusting for the noise in Q1 and Q2 taken separately. They could have done this calculation. That they didn't have the jobs numbers, to me, would be surprising. That they couldn't use the standard error to say, you know what, the job growth over the last 2 months is statistically no different than zero, and the beige book is suggesting weakness. 25 basis points to me seems rather reasonable. But I think Powell's decision was probably far more political than it was economic. He does not want to be pushed around. He is not going out that door like others have gone out the door under Trump in disgrace or in embarrassment. However, he's doing it to himself now because he has to defend this. Both Waller and Bowman released statements Friday defending their position, and this jobs report has completely vindicated Waller at this point. And you had a Fed governor resign. That came through later in the afternoon on Friday. When I saw it, I said, well, it makes sense when you look at this person's pedigree. Excellent reputation, has the ability to go back to the university and teach where they make more money. You don't make a lot of money in government service, and can avoid what is probably going to happen is an attack, a wider attack on the ones who didn't vote for a cut. And I guess she just didn't want that in her life, so she got the hell out of there. So I didn't talk about these numbers over here. Let me take care of that now. This is for the consumer, just to give you an idea of the weakness. This is 0.98 of the 3. If we look at the growth quarter over quarter, it was 1.4% growth. Q1 was 0.5. So the consumer consumer spending grew 0.5% from Q4 of 24 to Q1, and then another 1.4% into Q2. Last year, Q1 grew 1.9%, and Q2 grew 2.8%, double the growth rate last year versus this year. So that is not very good. So let's add it up. You have weakness over here, weakness over here, weakness over here, weakness on the exports, and the imports match off with inventories for this quarter, which reverses what happened in the first quarter, ending with a 1.21% annualized real GDP growth, well below the economy's potential. The job market's producing jobs for 3 months now, well below the replacement rate, just to keep the unemployment rate constant. This should have been a 50 basis point cut. Maybe we see a 50 basis point cut in September. Let's have a look at rates and yields. Big story here. Look at the 1 year pulling out 22 basis points. This really all happened after the jobs report. The big move just after the jobs report. So we're already pricing in one cut over there. Long end of the curve down significantly. TLT had a really nice week. It did not have a good day up to the jobs report. Going into the jobs report, TLT was threatening to break down under 86. By the end of the day, it was well into 87 territory, threatening to break 88, up 1.61% for the week. FOMC for September, 45 days away, a 25 basis point cut. You have an 80% probability. I think these probabilities continue to shift towards a 25. Maybe we'll start to see some weight on the 50 basis point cut. We have the trade balance in 2 days, both for Canada and the US for the month of June. ISM services in 2 days. China trade balance in 3 days. That is getting some attention. Bank of England interest rate decision in 4 days. Unit labor costs and productivity in 4 days. And Canada, its jobs report in 5 days. Look at SPX. Ugly week, down 2.36%. And that is pretty much attributable to Thursday and Friday because on Wednesday, July 30th, the market, both the NASDAQ and the S&P, made all-time highs again. And all of that disappeared in 2 days. And the dollar index was up strong and then gave it all back. to end up only 0.44. It was threatening to break up over 100 at one point. I was watching and going, wow, the strength here. Reverse repo under 100 billion, 97 billion. Reserves 3.3 trillion, and the TGA now at 419, and the target Besant said is 850 billion. So is issuing a little heavier on the issuance to try to get that build back up to 850. More issuance on the shorter end of the spectrum than the longer end, so less supply on the longer end coming up. We are inverted again, the 3-month to the 10-year, quite a bit now, 12 basis points, and probably going to continue. Although I'm going to present an argument a little later on that at this point, I think the long end of the curve could go either way, depending on what happens with the Labor Department and what Trump's next move is going to be. And hopefully it will be a good move. Well, what's a good move though, right? We probably have different definitions of what a good move is. Look at Fed funds futures. What a day. And I had a very good day on Friday with Fed funds futures. I had been buying the futures on the belief that there is going to be at least one cut. And last week with the Fed funds for October of this year sitting at 95.84. If there was one cut, it should be 95.92. I had said it just seems like it's easy money. It's money on the table. Well, I did close at 95.92. It went over 95.92 at one point, ended at 95.91. So I closed my Octobers because I thought, well, if you get one cut, this is where we would end up. I don't know if this is a 2-cut Fed, a 50 basis point cut Fed, and you still have a CPI report and a jobs report in September coming up. And if Trump does replace the head of that department, Bureau of Labor Statistics, by September, and that person says, well, let's give you the numbers you want, I would not be surprised to see revisions come out that say, oh no, the economy created 1.2 million jobs, and August created 423,000. Well, you're not getting a cut, right? If you're going to show the job market is really strong for the king's ego, you're not going to get a cut. You're going to get a cut as of right now, and that's what Trump wants. But of course, he's got to blame somebody for the lack of numbers. And it's getting a little long in the tooth to keep blaming Obama. Or even more recently, Biden. I mean, for a while, all the bad news was Biden's fault. It's a little too late to be blaming Biden. So you may as well blame a Biden appointee. It's manipulated. It's rigged. And he did use the word rigged. We'll look at his Truth Social post shortly. But look at this curve. 95.91, suggesting 4.09. So Q3, putting in 24 basis points. Basically firmly saying, yeah, okay, September justifies a rate cut. Honestly, I think we should have been cutting a meeting ago. We should be 2 cuts in right now, but here we are, right? Q4, 39, looks like a cut and a half. So 63, which is 2.5 cuts in 3 meetings, you know, possibility. Q1, another cut. Q2, another cut. So by the end of Q2, combining the two, you have 109 in 7 meetings, 4.5 cuts in 7 meetings. Going out to October, it is 127 basis points in there. That is 5 cuts in 9 meetings. I seem to think it's going to be more than that, but being that you had such a large move on the curve, my positions, I think I was up almost 40,000 across all of them. I took the profit because I think we're going to have some retracement of that. And, you know, as I was thinking later in the day about what Trump could possibly do with a replacement for Bureau of Labor Statistics and what could happen, I got a fear that if this is replaced quickly, September's numbers are going to be off the charts wonderful. No one's ever seen anything like this. This is the truth. This is the reality. The Democrats were, colluding to work against me, and it won't be a statistical report. It'll be a Sharpie that just crosses out a number and says, put these numbers, and they'll be off the chart numbers. And I thought, well, if that happens, there's no, you can say no cuts till May because there'll be pushback for sure. It's like, okay, you want those job numbers, you get no cuts. So I closed them. I think I'll have an opportunity to reopen them, but my focus is probably going to be on the October. If this falls back 20, 25, 30 basis points, I will probably go in heavy again. But this was a good week on the short end of the curve. Fed funds futures won. This was a good week on the long end of the curve. I would like to see follow through, but it just lacks follow through. And I think with the direction we're headed, or the direction that I suspect we're headed, I don't think this holds, and I don't think this holds. So let's move on. Okay, real rates all down as they should be, and look at the break-evens really coming down, sort of defying what we saw in PCE. And the whole narrative around tariffs are inflationary. We're going to have a look shortly at the tariff list. It's not good. I mean, it's just everybody gets something all over the place, and there are some countries that still aren't resolved yet. I cannot see how any of this is the president's purview to do, no matter what statute he's pulling out saying, I'm doing it under this, I'm doing it under that. This is really a power grab from Congress. So I do expect that by the time this reaches the Supreme Court, that much of this is going to be reversed, if not canceled outright. So I don't know that much of that holds. Anyways, there we are. Look at that. Just undoing most of what we saw in PCE. PCE came in slightly elevated. 30-year fixed rate 6.72, still a little too high. Down only 2 basis points considering how the 10-year moved. But then again, in all fairness, this is as of Thursday. We don't have the Friday look at it. So as of Thursday, that was probably consistent. OAS, again, this is as of Thursday as well. We don't have Friday, but OAS, look at this. Nothing to see here, nothing to see here, nothing to see here. Not much to see here. And in fact, we want more of this stuff going into the close of Thursday. Friday, probably those buyers were saying, damn it. Trump was active on Friday. Two things, nuclear subs he's sending to particular regions in the world because of things that were said. I don't know that the market is going to make too much of that because it really doesn't. Recall what I said before about good news versus bad news. Bad news actually has to show up. So it wasn't enough that we could look at the jobs report for the last 2 months and say statistically these are no different than zero, and they are rather weak job reports. Market continued to hit new high after new high after new high because it's not bad news yet. It actually has to show up, but good news doesn't have to show up. Good news could just be a whisper of a rumor, of a wisp on the horizon, and the market will go up. There is a saying that the market climbs a wall of worry. No, it doesn't. It doesn't climb. It goes up an escalator of hope. It only falls when the worry actually shows up. You got an invading army across the street. Someone will take care of that. It won't happen. Somebody will step in. It'll be taken care of. They're at the front door. They're not coming through the door. Somebody will. Not until they're in the house kicking your dog do Americans leave the house. So bad news has to show up. So nuclear subs heading somewhere? It'll be taken care of. It won't come to that, will it? Somebody will do something. The Russians will back down. Trump won't actually do anything. Not until a missile actually explodes in a city will the market react. So that one, I don't see much. This here did happen, though. Trump did fire someone. So data integrity was already a question because of the unreliability of the sampling sizes. You had wider standard errors than you really should have. The published standard errors were too small, given the smaller sample sizes. But if you underfund the data collection agencies, this is what you're going to get. Smaller sample sizes and unreliable data. Well, what if you just say, let's not collect the data at all. Let's just print in the numbers we want to see, which is where it seems that we might be headed. I was just informed that our country's, and of course you got to put that in quotes because, jobs numbers, you can see him doing the air quotes as he's saying it. The jobs numbers are being produced by a Biden appointee. No, they're not. They're not being produced by this person. They're being produced by the department. This is just someone who oversees the department. Commissioner of Labor Statistics who faked the job numbers before the election. No evidence provided there. Faked the job numbers before the election to try and boost Kamala's chances of victory. The same Bureau of Labor Statistics had overstated the jobs growth in March 2024 by approximately 818,000, and then again right before the 24 presidential election in August and September by 112,000. These were records. No one can be that wrong. We need accurate jobs numbers. I have directed my team to fire this Biden political appointee immediately, all caps. She will be replaced with someone much more competent and qualified. You know what that means. She will be replaced with loyalty. I wonder if there's a Polymarket bet right now that it's going to be a Fox News host somewhere that gets the job. How much? Is there anything on Polymarket? Leave a comment. I'm not on Polymarket, but there must be some bet on Polymarket about it'll be a Fox News host, competent. Somebody with no statistical background whatsoever. Somebody competent. Maybe they can slide Dr. Oz over into that position. It'll be someone who is loyal to the administration, who wants to tell the same story. A Carolyn Levitt, who will scream numbers at you of how wonderful they actually are. Important numbers like this must be fair and accurate. They can't be manipulated for political purposes. Again, no evidence whatsoever that they're being manipulated. He just says it, and for 35% of the American population, that is the truth. Truth is what Trump says it is. Said there were only 73,000 jobs added, but more importantly, that a major mistake was made by them, 258,000 jobs downwards. It's not a mistake. That is just what you get with sampling. That is what you get, especially if there's a bias in the reporting. So let me explain what we mean by a bias. Let's say that we sample a group of, let's say, 1,000 people, all with different characteristics. Some of those characteristics may lead to a high survey response, while some may lead to a low survey response. So you have this population and you want to be representative. But if you divide the population by response rates, you might find you have a high response rate and a low response rate. If you look deeper, the high response rate might have certain characteristics that are different than the low response rate, but you need them all for the sample. In these types of samples, the thinking is, or the theory is, those firms that are larger and well capitalized have the resources to spend the time on the survey, but the smaller firms who may be more resource constrained don't have the time to spend on the survey or get it in on time, so it tends to come in later. So the ones that are having more difficulty tend to report later. The ones that are not report early, thereby making it appear that there is job creation. Meanwhile, the ones that are more disadvantaged, who are maybe downsizing or not hiring, come in a little bit later. This is very common when you're doing statistical sampling, is that you won't have a consistent response rate, That if you say, well, our response rate is 40%, you'll have some in your sample that had a response rate of 60% and some with a response rate of 20%. As a researcher, you then have to dive a little deeper and say, is there something characteristically different between these response rates that will affect my data? And that is where we are. So it is just the nature of statistics. But do you think that you could convince this administration of that? The one person in particular, do you think that there is any rational argument that they would listen to or that they would understand? Similar things happen in the first part of the year, always to the negative. The economy is booming under Trump. Of course it is. There can be no other narrative. There can be no other narrative, despite a Fed that also plays games, this time with interest rates. Well, they lowered them twice and substantially before the presidential election. I assume in hopes of getting Kamala elected. How did that work out? Jerome Too Late Powell should also be put out to pasture. I'm not done, he says. Continues on. In my opinion, today's jobs numbers were rigged in order to make the Republicans and me look bad. Just like when they had 3 great days around the 2024 presidential election. And then those numbers were taken away on November 15th, right after the election, when the job numbers were massively revised downward, making a correction over 818,000 jobs a total scam. Jerome Too Late Powell is no better. But the good news is our country is doing great. This is 1984. This is Big Brother. Do not look over there. Look over here. Your rations have not decreased in size. We have increased your rations as the administration decreases them. Just tell people they're increased. If this happens, if they replace this person, a Trump appointee is going to have to pass the loyalty test. And if it's somebody who lacks the educational background for this, are you going to believe the September numbers? Especially if they come out with revisions saying, oh, no, the revisions were the other way. The economy was adding 400,000 or 500,000 jobs a month, and the September jobs numbers is 400,000, 300. Are you going to believe it? Now, if you don't, if this is the case, then we are in a situation where everyone is going to be afraid of bringing the king bad news because they're going to get fired. So only good news will reach the king. And if it's not good news, make it good news. That makes that I think brings the U.S. another step closer to becoming an uninvestable country. All right, we had 3 statements issued by the Federal Reserve on Friday. Statement by Governor Waller. It wasn't even in a speech. It just, here's my statement. I dissented, and I'm going to tell you why. First, tariffs are a one-off increase in the price level. Do not cause inflation beyond a temporary increase. Standard central bank practice is to look through such price level effects. And Powell said as much 2 meetings ago that it's a one-time effect. He even brought out the word transitory again, and now he's abandoned it. Second, a host of data argues that monetary policy should now be close to neutral, not restrictive. Real GDP growth was 1.2 in the first half of the year. So they had the number. We just calculated it a few screens ago. You saw that. We saw where the weakness was. So clearly they had the number and they still didn't go. I'm with Governor Waller on this one. Expected to remain soft for the rest of 2025, much lower than the median FOMC participants' estimates of longer run GDP. Unemployment rate is 4.1%, near the committee's longer run estimate. Total inflation is close to our target and just slightly above 2% if we put aside tariff effects that I believe will be temporary. Taken together, the data imply the policy rate should be around neutral, which the median FOMC participant estimates is 3%. We're at 4.33. Now that is 133 basis points lower, right? Not where we are, 125 to 150 percentage points above 3%. Final reason to favor a cut now is that while the labor market looks fine on the surface, once we account for expected data revisions, wow, it's almost as if he saw the numbers, right? Private sector payroll growth is near stall speed. And other data suggests that downside risks to the labor market have increased. And that's true. That's what increased tariffs will do. They are job destroyers, not job creators. I'm with him 100% on this. I've been saying this for some time. It's almost as if, look, he had some view. I mean, once we account for expected data revisions, because revisions can be to the upside just as much as they could be to the downside, but this guy had it right on. So they must have had the data. Powell says as much. Yeah, we do get an early look if it's coming out that week. We do get an early look. So they saw all this and still did not cut. It's political now. And the only way to make it not political is for, well, one side to stop talking about it so that the other side can say, okay, it's not political anymore. But with the firing of the head of the BLS, guess what? Now that is political. Let's see what Bowman had to say. What are we doing here? We have this. Where is Michelle Bowman here? Let's refresh. And last updated, and I am not getting it. Oh, there we are. We're at the bottom. I got it. I dissented. And she has her reasons. U.S. economy has remained resilient, although underlying growth has slowed markedly. Labor market has remained stable near estimates of full employment. We're also seeing meaningful progress in lowering inflation towards our 2% target, excluding tariff-related increases. I'm not going to go through much of it because hers is a little bit longer. Increased concerns about our employment mandate. In terms of risks to achieving our dual mandate, I see upside risk to price stability has diminished as I gain even greater confidence that tariffs will not present a persistent shock to inflation. With inflation on a sustained trajectory towards 2%, softness in aggregate demand, and signs of fragility in the labor market, I think we should start putting more weight on risks to our employment mandate. With memories of pandemic work shortages still fresh, firms have restricted reducing their workforces in response to slowing economic conditions. This is true. We would see elevated initial claims. We're not seeing that. So firms are not wholesale saying, let's lay people off, but they're not hiring. They're not creating jobs. And they've appeared to be more willing to reduce profit margins as they are less able to fully pass through higher costs and raise prices given the weakness in demand. If demand conditions do not improve, firms may have little option other than to begin to lay off workers, recognizing that it may not be as difficult to rehire given the shift in labor market conditions. And we have seen from companies reporting this quarter their forecasts for the hit they're going to take because of tariffs. And many of them are saying we can offset that with cost savings and productivity gains. Translation, we can fire people. That's usually what happens, is we can get rid of people to make up for the difference. And that is usually what happens. This is why we say that tariffs are a job killer. You know, Republicans like to point out that there is not a single observation in history of a successful socialist system. And that's true. But it is also true that there is not a single empirical observation in history of an advanced economy instituting tariffs and actually growing. It is a job killer. It is a growth killer, the path as I see it. Tariff-related price increases likely representing a one-time effect. It is appropriate to look through temporarily elevated inflation readings. I agree. I recognize economic conditions are shifting. I believe that beginning to move our policy rate at a gradual pace towards its neutral will help maintain the labor market near full employment, ensure smooth progress towards achieving both dual mandate goals. I'm not going to read the rest. In both of these, I don't see anything about the incoming effect of AI. It's almost as if they don't want to talk about it. That in 2 years they say, oh, thank God we didn't say anything about that AI, that crazy fad. It's not a fad. It's a thing. And these models are getting better and better every day. It is a thing. We're in August. We're expecting ChatGPT 5 this month, being billed as the world's most advanced model. Why aren't they saying anything like that? If you're talking about the job market, to not say it to me seems, as researchers, sometimes we're trained to, and I'll do air quotes here, listen for the silence. So that when you're reading a paper and it's clear that the author is not talking about a particular thing, that's usually where the weakness is. They're not talking about AI. What's going on there? And then look at this. I saw this come through because my email is with the Fed, and so whenever they post anything, I get an email right away. Adriana Kugler submits resignation as a member of the federal board effective August 8, 2025. No reason given, wasn't at the meeting, so an alternate voted instead. Submitted her letter of resignation to President Trump and will return to Georgetown University as a professor this fall. Probably gets paid more with an easier life, and this guy is coming for you. You know that there is a possibility that you're going to get a name, you're going to get called names, you're going to get bullied. So why not get the hell out of there? This looks like, and maybe she sort of felt that was building up in there and thought, I don't want this in my life. I don't know. There's no excuse given. If there was something else involved or something different, maybe there wouldn't have been a return to Georgetown this fall. But returning to Georgetown this fall, now she was done in, I think, January. Really only had a few more months to go. Could have sailed it out until January and said, okay, I'm good. But no, got the hell out of there now. So that, I don't think got enough airplay. I think that's a big deal because Trump now gets to fill that spot with a loyalist. So he's got two people on his side. Now he'll have three. And then he'll change the Bureau of Labor Statistics to make sure that the data looks good. And who knows? Let's find all the other Biden appointees that are at CPI, that are at PCE, that are at the trade, that calculate the trade balance. Let's find all these Biden appointees and let's replace them. The problem is the data is not supporting our agenda. If only the data were better, things would be great. Doesn't that make you nervous? Now, if the data comes into question, if you start questioning the reliability of the data, you lose investment signals. And if you lose investment signals, you just stay away because you really don't know what's going on. You no longer have any clue. It's one thing to say, look, the sample sizes are smaller, so the standard error is wider, but the integrity is there. Everyone understands statistics. If you have a small sample, it will still tell you some truth with a wide standard error. You get that. But that it is unbiased, the integrity is there. But if you question the integrity of the data collection and of the data presentation, well, then you lose all signal altogether because there's no standard error you can apply to a made-up number. All right, the White House has published a list of tariffs. Some countries are not on there, so they make a note at the bottom. Countries that are not listed are facing an additional 10%. Everyone's got 10. So if you're not listed, you're at 20. And then there are exceptions, China and Mexico, still in negotiations, but Canada 35. China, we want to work with them. We want to see where we can go. Let's see what we can get to. Canada 35. Just because we didn't want to be the 51st state. That's an ego trade. That's why I say I find it hard to accept that the Supreme Court will say, oh, no, you're fully justified when you hit Canada with 35 based on fentanyl. That was his excuse, based on their lack of ability to control the flow of fentanyl, which is, come on, we all know that that's not true. So here are your rates: 15, 30, 15, 20, 15, 30, 15, 10. But Brazil has been carved out for almost 50% on other things. 25, 19, 15, 15. Look at this. It just keeps on going. Laos, 40%. What did they ever do? 40%. Myanmar, for 40%. Lots of 15. There's an 18. Even Costa Rica's on here. Costa Rica is 15, so look for your pineapples and maybe some of your avocados to increase in price, but primarily your pineapples. If you buy them at Costco, Costco has the Costa Rican pineapples. Maybe they'll switch to the Hawaiian pineapples, who knows. Special cases, European Union, 15%. A lot of that was for show, by the way. I mean, if you dive into a lot of these announcements, they're not trade deals. They're announcements of sort of like a broad term sheet that they can then begin the long discussion about what the trade deal looks like, and that's Congress. That's not the president. Countries not listed are subject to 10% additional tariff. This was the big deal. We'll talk about this soon. Copper, 50% tariff for semi-finished copper and copper-intensive derivative products, but not copper itself. And it took a dump, like down 20% in one day. It was ugly, and then it continued the next day. I don't think that's over. Transshipped goods. This means that it ships from China to another country. It lands in that country, and then it ships from that country, thereby showing that that is the country of origin that it shipped from, or at least the most recent, but it was transshipped. To evade higher tariffs, face a 40% penalty tariff. India is on here as well. I think India is at 25%. That's important because we're going to look at Apple. We're going to look at the 20 things we should know from its earnings, and we're going to see that about half the phones shipped to the US come from India. So Americans are going to pay, on average, about 12.5% higher if they want an iPhone. This is Perplexity. I used Perplexity to ask the question. Perplexity is quite good. It gives you all of the sources up here of where it's getting stuff from, so that you can actually just go right to the source and check the source yourself. So you got a pretty good fact check on what sources we're using these. You can see, you just scroll right across, and then it tells you there are 9 more. So if you have questions about this sort of thing, I find Perplexity the best because it gives you an answer that you can read as opposed to a list of URLs. Now, I am a Google investor now. I do have exposure to Google. I should be telling you to use Google in AI mode, but here I am with Perplexity. Maybe I should rethink my Google position. All right, 2-year copper chart on the screen. Last IV 23.9. I know that's a little bit sad. I was really hoping on this big drop down over here. IV jumped at one point. It was over 80%, and then it dropped very quickly to 70, then 60, then 40. But no bids and no offers on any of the options. There was nothing there, nothing at all. I put out a few offers, nothing. And there was like nothing. Nobody was interested, and anybody who was putting in a bid was putting in it really low, and I'm putting my offer really high, and we're so far apart. And now it's 23.9. When it was way up here, IV was close to just a little over 40% on copper. That's why I was selling calls on copper, because like, look at this IV. You can position at $6.50, $6.75, and $7 and get good premium. Not so much now. 23.9. I am really disappointed in the market makers on this one for not making a market in options. They just abandoned their responsibility. They're supposed to make a market, and they just said, I'm not doing it. Nobody did. No market at all in the options. So we're over here, 443. Look at this. We were up here. It threatened $6 for a while, but we were over here. I've drawn 3 lines here, 420 to 4. This is the range that copper had been in for a while before it broke out above that. But up here, it always had a premium to LME. That premium is now gone. The 420s, you can, if you sold puts at 420, the average in there, the mid of the spread is 0.0972, which is $2,430. It sounds interesting, right? But keep in mind, you got 25,000 pounds on each contract. Every dime is going to be $2,500. So if it goes down to $4 from 420, you'll be down some $2,500 to $2,700 per contract. The $4 put is paying $13.25. You can get it for about 5.3 cents. And the 387 put, which is the bottom over here, pays $8.1250. You may think that these are decent enough numbers. This is October, 85 days to expiration, but I do expect this to continue to drift down. And if this drifts down, these premiums will drift up. It may not breach, $4, but these premiums will still drift up. And with the mark to market, you're going to need liquidity because money will have to leave your account every day. So you may get $13.25. That's restricted. But let's say that the premium doubles on this. Such that you're down $1,300. That means to hold this, you are going to your account is going to drain by $1,300 US with the mark to market before it starts to turn back in your favor. So you're going to have some liquidity issues before expiration if it continues downwards, which I think it will. Inventory at COMEX as of July 31st is 234,000 tons. Now, when it was up here, I am sure you had a lot of arbitrage between London and New York. It's to buy the physical stuff in London, sell the futures in New York, and then deliver. So you're still going to have inventories coming in over the next month. This number, I don't think, is done just because the tariffs are off. You got a lot of these contracts that are going to deliver because they're going to get 560, 570, 580 per contract. They're going to deliver. So look for this number to continue to increase. In metric tons, it's 9610. LME is 9630. You now have a $20 per ton discount. Not enough to begin to shift sending inventory from New York to London. You need a bigger discount if you want to clear those inventories. So right now, I'm not that interested in selling puts on copper, not until it breaks under 420, and I think you'll eventually see it break under 410. That's when you can start to say, okay, well, now the arb trade between New York and London is starting to look interesting, but there's got to be a big enough differential to make that happen. I think this inventory continues to rise. This discount continues to increase, which means this price continues to drift down another 30 days because we're going to have to see those inventories just not go anywhere and those inventories build. And if you do have a slowing U.S. economy, the demand for copper to have withdrawals from that warehouse domestically will be lower as well. So this has sort of created a technical issue with copper. I have sold puts on copper miners, FCX and Southern Copper. I have sold puts on the miners because in this situation, I will take the miners over copper until inventories are worked off. Why? It would have been irresponsible for the mining companies not to aggressively begin to sell more of their output forward at that price. When you get this kind of gift, you take it. It didn't take me much to figure out that this would have been a stupid tariff. And I'm not in the industry. And I just felt this is a stupid tariff given where copper sits in the supply chain in the US, and that you can't just come up with a copper mine or a copper smelter. You can't just come up with it. So you need to bring in the raw copper. They could have figured that out too. That if they were hedging 30% of their production, it would have been irresponsible not to hedge 50 or 60% of your production at these higher prices. Maybe not 100%, but hedge a bit more. So I do think that the miners probably have some nice margin in their revenues going forward. The realized sale price I think if they did this, the realized sales price will reflect that period of time and less so this period. So I'm willing to sell puts on the miners, but I'm not willing to sell puts on copper. But as soon as I start seeing these inventories come down, once you get to a big enough discount to the LME, these will come down very quickly because LME's inventories are super low. New York is super high, and I still think there's more coming into New York. Once this discount gets bigger, it'll start to flow the other way. Then you'll start to get price stability and then start to reflect fundamentals instead of an inventory overhang. 60 to 90 days. Sometime maybe September, October, I think you probably might get to a point in copper where all of this is worn off and it's now beginning to recapture the fundamentals underneath. And that's if the economy holds up over that period of time. But right now I'm out of the HG contract, focusing more on the miners. Okay, let's get to SPY. That is becoming interesting. Forward 4-quarter operating earnings sitting at 281.15. No revisions downward on this one yet. That is down 22 cents week over week, but the index is down 150 points week over week, 62.38. Still at over 22 times forward earnings, 22.18 in an economy where it's growing at 1.2%. And 3 months now, your jobs reports are but September could just be incredible. 2 million jobs created. We have that to look forward to, right? The 22.7 down to 22.18. With the return of volatility, 13th week percentile, the 78th percentile over the past 13 weeks, 69th percentile over the last year. That was 0. It was like the lowest in 13 weeks last week. Now it's in the 78th percentile. That's nice. All-time high. July 30th, 638.95. That is that green bar just right in here. And then Thursday, Friday, bang, bang, down 2.77% from the all-time high. A pullback of 5% would put you at 607, which I feel is warranted. I didn't look at Bitcoin today. It's more of a risk-off, risk-on sort of thing. But it was down another $1,200 yesterday. Sort of signaling that risk is carried over into the weekend, that there wasn't a Saturday rebound saying, whew, okay, that was an overreaction. 10% correction would put you at 575. This market, I don't know, it just doesn't get that kind of thing. It just gets these V-shaped recoveries no matter what is going on. And those V-shaped recoveries will work until the very last one. Right? But you don't know which one's the last one. Is this the last V-shaped recovery? Is this the one where you say, okay, this is not going to be a V, or is it going to be a V? I don't know. So I am looking at things I want to own. I love these red days, by the way. When everything is red, good stuff gets thrown out with the really overvalued stuff. So these stocks that are trading 30, 35, 40, 45, 50 times earnings, they come down. But the stuff that's 16, 17, it comes down as well. So you get to buy really good stuff at lower prices. So I bought a couple of Canadian miners that had dropped significantly, whose dividend is now over 6%, who have a long history of dividends. So I'm looking for that kind of stuff that, hey, if I can grab these 6-7% dividends when they're normally 3.5 to 4 to 4.5%, I'm in there. So I am going shopping when these markets are red. I'm not buying the big names though, but value names get thrown out. That's what I'm looking for. IWM is in correction territory again. IJR is in correction territory. Small caps getting no love at all. Going into the end of last year, it was small caps getting all the love. I disagreed with it. Now it's not getting any love, and I disagree with that. Why am I always on the wrong side of the fence here? QQQ, another all-time high, July 30th, and it is down 3.5%. And we have earnings this week, 124 and 124. And I said, what? At at a big number like that, you both agree on 124. So that was my attempt at drawing fireworks. I don't know if that came through. But I got really excited. I thought, well, okay, I haven't checked to make sure that both of them agree on the company's number one and on the dates. But still, to be equal at 124, that's at least a victory. And then I was disappointed because Sector Spider lists both Class A and Class B shares for a company. Meanwhile, it's one company, and it did that twice. So that turned into disappointment when I saw that it was 122. And then even at that, I said, it's probably not right either. They probably have some companies reporting on Friday that really report on Monday, and a name of a company that reported 2 weeks ago. And these guys will probably have companies that report next week. Who knows? It's just a shit show. Anyways, let's have a look at the shit show. Okay, August 3rd to August 9th. Here's our list, and I am at the mercy of Sector Spider here, so I'm just going to take their word for it that these companies are reporting, and they're reporting on the date that's listed. If they're not, and you object to it, you're going to have to take it up with these guys. So Monday we have some energy companies reporting. onsemi is reporting. Tyson Foods in the staples, and in real estate, Simon Property. They're a fairly large one. Fairly large. These are all S&P 500 companies, so they're all fairly large, so that goes without saying. Going into Tuesday, anything interesting here? DuPont. There's C, Class A and Class B. There's Fox News. Marathon Petroleum. We got some financials in here. Industrials, the big one here, Caterpillar, which means that Deere can't be too far away. They tend to report very close together. Cummins for engines. There's Palantir. AMD. Who cares about Supermicro, right? And then the one I get confused with the ticker is ADM. AMD here, ADM here. Let's make sure we say that right. Molson Coors. Duke Energy, there's half of Florida right there. You got Pfizer down here. Yum Brands, let's see if that gives Darden a boost. Darden did fairly well last time, traded up to over 230 and all the way down to 200. So let's see what Yum Brands can do for that. And going into Wednesday, News Corp, there's A and B. There's Walt Disney as well. Oxy is on Wednesday. Some financials in here. Nothing really strikes me as interesting. Nothing that I follow. Uber's been doing well. Uber in the 80s. Last time they reported they had some currency issues. Traded down, sold some puts, made some money on that. But the real play would have been just to buy them at the time. So let's see if they can maintain their elevation. Who else have we got? Iron Mountain in real estate, data storage. We have some utilities. Healthcare. I couldn't tell you what most of these companies do. I've avoided healthcare and biotech pretty much my whole career because I don't have the science behind it. I don't understand what I'm looking at, so maybe I should take the time to learn it, but it just seems like, it's such a big sector and you got to have all the specialized knowledge. I just don't really worry with too much. Airbnb and McDonald's in the consumer discretionary. Going into Thursday, Warner Brothers. We have some more energy companies, some more financial here. Fortinet in the cybersecurity space. Who else have we got in here? Anything interesting? Realty Income. That's another fairly large one in its space. Whole bunch of utilities in here. Nothing much down here. And on Friday, anything big that we want to pay attention to? Monster Beverage. Well, that's it. Let's end by having a look at Apple. Reported earnings Q3. Even though it is Q2, it is their Q3. These are available for download for free off of Google Drive. The link for that Google Drive is on our Discord. I think we have like 23 companies up there. I was doing this as a test to see if there'd be any interest in them, and it seems like there is. So I will keep going with them. Um, Apple had a meeting after their earnings. Tim Cook talked to the company-wide meeting, and was saying, you know, AI is ours to lose. We have to win this AI race, and they are open to acquisitions. What's going to happen there? Let's have a look at their key financial performance. Record-breaking revenue, 94 billion in revenue. Pretty much the same as Google. Apple and Google, same revenue. Up 10% year over year, significantly beating analysts' expectations of 89 billion. Represents Apple's largest quarterly revenue growth since December 21. A new June quarter record. Strong earnings beat. Earnings per share 157, up 12% year over year. Well above the expected 143. Net income reached 23.43 billion, also a June quarter record. Gross margins 46.5 compared to 46.3. Slight expansion in gross margins. Revenues up, gross margins up. What's not to like about that? Earnings per share up. Sounds good, right? Product segment, iPhone. Revenue grew 13% year over year to 44.5 billion, significantly beating expectations of 40 billion. iPhone 16 sales were up strong double digits versus the iPhone 15 predecessor. But some of that, we're thinking, was front-running in front of tariffs, and we'll see a little later what the tariff effect might be for the iPhone. Mac business revenue grew nearly 15% to 8 billion. Yeah, but that's because you significantly raised the price. I used to pay about $3,000 a computer. To buy this latest one was $10,000. It's still just one computer. It's because you raised the price. But still it's revenue. 15%. Fastest growth among Apple's product categories, driven by updated MacBook Air laptops released just before the quarter started. Services revenue reached an all-time record of 27.42 billion, up 13%, beating 26.8 or the expectation. High margin segment continues its consistent growth trajectory for service revenue. The important metric there is not units sold in any quarter, it's the installed user base. It's how many units of something you have out there. That forms the basis on which you can sell services. And yes, there is advertising in the middle of this because these are freely available for anyone. And one truism of the economics of anything is nothing is free. We got to find other people to pay for it if we're going to do something for free. You want this for free, which I'll give you for free. Got to find somebody to pay for it. So it put ads in there that somebody may look at that and say, CFA, huh? Well, what's that all about? Maybe I'll think about that. Or maybe next year, instead of another a supplier, I'll use this guy. This guy looks like he's on top of things, right? I am. iPad revenues declined 8% to 6.58 billion. By the way, I bought the new iPad. Well, at least the one that's available, the most up-to-date iPad now. It is much lighter than the iPad that precedes it. It is about half the thickness. So when you hold them both in your hands, the new one feels cheap. It just feels like they've cheapened it. It feels lighter. As far as performance and brightness, I don't see any difference. You know, if you tap on the same things on each one and you go through the different menus, if you go to download a movie from Apple, there's almost no difference. Yet I went from $1,200 for the last one to $2,000 for this one for what feels like a cheaper thing. I don't know. I'm at the point where it is the maximum price that you can charge me at this point before I say, you know what, I got to go back to Windows. This is I can't justify these prices any longer because in 2 years you're going to put updates on my system that massively slow them down and force me to upgrade again. I won't do it. I'm at that point where it's enough. iPad revenue declined. Wearables, home and accessories dropped 9% to 7.4 billion. Apple achieved growth in every geographic segment. America is generating over 41 billion, Europe at 24 billion, showing broad-based global demand. This is sort of, an offsetting argument against, well, okay, iPhone sales were because of front-running tariffs. It's only the U.S. that's handing out tariffs like a mean professor hands out Fs. Greater China sales rose 4% year over year to 15 billion, reversing previous declines. Cook specifically noted the Chinese government subsidies helped Apple in the region. Asia Pacific momentum. Japan and the rest of Asia Pacific recorded double-digit percentage growth, with the latter growing almost 20% year over year. And there's the iPhone milestone. 3 billionth iPhone. Apple shipped its 3 billionth iPhone since the product launched in 2007. Tariff costs. Apple incurred approximately 800 million in tariff-related costs for Q3, below the estimated 900 million, suggesting effective supply chain optimization. For the September quarter, Apple estimates tariff costs could reach approximately 1.1 billion, assuming current global tariff rates remain unchanged. And it has shifted a lot of production to India. Nearly half of US-bound iPhones are now manufactured in India. Nearly half of US-bound, let's make sure we say that right, manufactured in India. Production capacity expected to reach 60 million units by 2026, reducing China dependency but at higher costs. 25% tariffs. But, who thinks that China would have gotten lower? So, yeah, it's 25%. It is still a low-cost labor country to be in, but you're at 25% tariffs, and half of those are U.S. bound. Probably would have been higher with China. Here is the AI. They don't really have a coherent AI strategy right now. Google has a very coherent AI strategy, but not a very coherent let's save search strategy. I have younger, I'm going to call them kids, younger kids that work for me. I can call them kids anytime you're separated by more than 30 years, they're kids. I have younger kids, 20, they're about 20, 18, 19, 20, doing data entry for me. They don't Google search anything. They use ChatGPT as a search. They search everything on ChatGPT. Let's look at what Apple's doing here. Cook stated Apple would significantly grow its AI investments and announced the company is open to M&A that accelerates our roadmap, signaling aggressive AI expansion plans. The sort of rumor out there, or the hint out there, is that Perplexity might be on their radar. That would bring them not a foundational model, but that would bring them into a search position very quickly. But they have abandoned a foundational model. They don't have one. It might be a good strategic move on his part. In his meeting, his all-hands meeting, he did say that Apple rarely is the first. That the computer existed before the Mac. That mobile phones existed before the iPhones. That tablet computers existed before the iPad. So he was making that point that we are rarely the first, but we are usually the best. And I don't know, does that follow suit with AI? I don't know. Maybe it was going. Maybe in hindsight we'll look back and think it was a brilliant move not investing all that money in a foundational model, because they don't make money. It is hard to see, even with OpenAI's $200 a month charge. They say they're still not making money on that. How do you price it then? Right? I mean, unless you can get the cost of producing the answers down significantly. With bigger models, it's just going to cost more. How do you begin to price that? And how many people are going to pay for that kind of pricing? I don't see this globe, this world, as being able to support more than 2 big foundational models, which means a lot of this stuff goes away. And maybe the foundational model will be more like the utility. very small return on it, but it's what you can build on top of the utility that has the value, and maybe that's where Apple goes. But they've got to show something, right? A redesigned, more personalized Siri is slated for rollout in 2026 alongside iOS 26, Mac OS 26, iPad OS 26, all things that are meant to slow down any hardware you currently have. That pisses me off, indicating Apple's AI roadmap timeline. And I'm sure they're going to make a bunch of AI-enabled hardware, and their software upgrades will slow down your non-AI enabled hardware to force another upgrade cycle. I truly am, as I said, at the limit of what I'm willing to pay for a computer that only lasts 2 years. I'm right at the edge. You've pushed me as far as I can go here. Shareholder returns. Apple returned over $27 billion to shareholders, $3.9 billion in dividends. Dividends small. $21 billion in share repurchase. Given the size of this company, these are small numbers. Apple declared a cash dividend, 26 cents per share. Really, I mean, $1 a share. It's like 0.5% dividend yield. It's there, but I don't know that you're looking at it going, oh, it pays a dividend. Apple expects mid to high single-digit revenue growth for the September quarter, with services growth expected to remain similar to Q3's 13% year-over-year pace. That's a bold statement. Apple's installed base, this is the big thing for if you're looking for services, and if you can support this, it is having that installed base grow and grow and grow over time, which they're making money on the installed base because they are killing on the hardware, and then that becomes part of their service. At some point, their pricing is going to start working against them, and the installed base will grow slower and slower, and if that grows slower and slower, services grow slower and slower. So they're going to have to balance that at some point. Apple's installed base of active devices reached an all-time high. Everything's hitting all-time highs. Everything's hitting all-time highs. By the way, when I looked at my age yesterday, all-time high. Today, another all-time high. For me, an all-time high. Across all product categories and geographic segments, providing a strong foundation for services revenue growth and future hardware upgrade cycles. Yeah. If you stop with this nonsense of slowing my computers down every 2 years and making me pay even more for something that is about the same, if not slightly, just slightly better, but not significantly better, I am getting tired of it. Anyways, there we go. Oh, at the very bottom here, this is our level 2 packages. Level 2, I believe, is open, I think, this week. This week or next week, level 2 opens, so you can start getting level 2 for May of 2026. There's where you want to be. The self-study plus applied analysis. Before we go, let me just show you where we are in the applied analysis. Okay, here is the modules in the applied analysis. Sector studies. I'll show you infographics. This is really cool. Financial modeling. It's getting its own Q bank, and the I was going to take really difficult sections from different companies to model, and I thought we can do this better in the Q bank because I can give you a small little case study, and then in the answer give you the process by which you would model that. So I think using the case studies in the Q bank is better, so I've been focusing on that. There's AI for finance. I'll continue to add to this. I'm just taking a small break till we get some new models out, and then we'll continue on. Let's just look at sector studies here. We'll go into that, and then we'll look at what Infographics has to offer. I've been adding the PDFs here. So where have I been adding quite a few of them? Let's go to the energy sector. I've added quite a few here. So you can see energy. We'll click on this one here, and there is the PDF. It's just, you just scroll down and you can read. It just keeps going and going. And then we have oil, gas, and refining, oil and gas refining and marketing. There is the sector study for that one. The energy sector one is GICS code 10. That's at the sector level. Then I got one for each of the sub-industries. I finished exploration and production, that's a really long one because it's so technical and detailed. And I'm just finishing up the coal industry one now. And here is your PDF for oil and gas storage and transportation. They're quite detailed PDFs as well. So we'll go back and we'll look at the infographics, and these are really neat. When I showed you Apple, we went through Apple. These are 20 things you should know. I put them in prompts. All of them are prompts, so that you can then take it, the prompt, and you can go to your LLM and you can say, with respect to Apple's Q3 2025 earnings, tell me more about quote, paste the prompt and unquote, and it will go into more detail about what you're looking at. Same with these infographics. They're all in the form of prompts. So we'll, where's a good one to start with? We can start with, actually, I think energy should mostly be up right now. So here's, this is at the sector level, the critical top 10. And again, these are all prompts, right? So you can say, with respect to the energy sector, tell me more about quote, and you just cut and paste this first part into the LLM, and it will expand more if you want to create or you want to dive deeper into a particular point. But 10 things you need to know about the sector, the energy sector. Once you have the energy sector, there's only one industry group in energy, and it's energy. Some sectors have 2 to 3 industry groups. Energy only has one. So there's no point in doing an infographic at the industry group level when the industry group is the sector. Here is your industries. There's 2. There are the services industry, and then of course the extraction industry. So if we click on energy, equipment, and services, I give you 20 things you need to know at that level. And there's the 20 that you need to know. Then you select a sub-industry. So let's go into oil and gas drilling. And at the sub-industry, I give you 30 points about that particular sub-industry that you should know. And again, these are all prompts. I've worded them all in terms of prompts so that you could take any one of these and dive deeper on your own. Then you can select the company. We have Noble Corporation and Seadrill. And then you just scroll back up and you could say, okay, well, let me see oil and gas equipment and services. And it changes to that. And there are 30 prompts. And again, whichever one interests you, all in different categories. So the categories that we have covered here: core economic and market dynamics. Then it goes on to financial profile and strategy, energy transition and future outlook. I think that's it. And then you can select the company. We've got Schlumberger and Baker Hughes in there. This is energy equipment. You can go to oil, gas, and consumables, and that gives you 20 points at the industry level. Then you can select the sub-industry. We've got all the sub-industries in here. So we click on coal and consumable fuels. There you go, 30 prompts that get you up to date on the coal and consumable fuels. I'm almost done the PDF on this, which will show up in the sector studies sector, and I think we're doing alpha metallurgical resources for this one, the met coal company, and going to try to find a thermal coal company as well. All of the sectors, sector groups, sectors, industry groups, industry sub-industries, and companies within the sub-industry will be filled out over time. So this, if you say, you know, I'm interested in this company, you go to the infographics, you go to the sector, you read the 10 things you should know about the sector, you read the 20 things you should know about that particular industry, you read the 30 things you should know about the industry group, and then you can click on the company and there'll be 40 points you should know about the company. It's a 100-point system, right? 100 points to read. Once you get through that, you should really know that company, because that company is embedded in a sub-industry, that sub-industry is embedded in an industry, that industry is embedded in an industry group, and that industry group is embedded in a sector. Yes. For this is applied analysis. For applied asset management, I am filling out the QBank now for options with very advanced scenarios and a selection of which option strategy, given what I just told you, which option strategy is the most optimal to use. So hopefully I can get quite a few of those filled out over the next week. And that'll take us to the end of this week. Yes, this is a shameless plug for my business, but again, the Market Outlook is free. I don't monetize it. Nothing is free. We got to get some people to pay for it. So if we get some subscribers saying, hey, this looks good, there you go. All right, that's it for the week.